look at Chapter 2. And as you can see, Chapter 2 is called Conceptual Framework Underlying Financial Reporting. So again, we have a list of objectives of learning objectives that you should achieve after this session. So the first one is that you should indicate the usefulness and describe the main components of a conceptual framework for financial reporting. Identify the qualitative characteristics of accounting information. Define the basic elements of financial statements. Describe the foundation principles of accounting. Explain the factors that contribute to choices and/or bias in financial reporting decisions. And discuss current trends in standard setting to a conceptual framework. So just looking across, there are the headings again, and the first one is around conceptual framework, so the rationale for it, the development of it, and we'll revisit information asymmetry that you may recall. We looked at adverse selection and moral hazard in Chapter 1. And then the objectives of financial reporting, the qualitative characteristics of useful information, and elements of financial statements. And within the foundation principles, we'll discuss when you recognize and when you don't recognize items in your financial statements, how you measure it, and how you present and disclose it. And then financial reporting issues, so we're talking about the principles-based approach. So if you remember from Chapter 1 with the principles-based approach, so for ASPE, so private enterprise companies, they report typically under Canadian GAAP, whereas publicly traded companies report under IFRS. And we look at financial engineering and fraudulent financial reporting. So the framework is like a constitution. It's a coherent system of interrelated objectives. So what does that mean? So it's basically just like what is a framework? It's basically an environment or a model where it's capturing all your financial standards and objectives all under one roof, effectively. So it aids the creation of standards for the accounting profession, just to make sure that everything is properly interrelated and there's no overlap or duplication. So it increases financial statement users' understanding of and confidence in financial reporting because it's structured, and enhances comparability of financial statements of different companies. So that's important because we talked in Chapter 1 about who our stakeholders are. So some of our stakeholders are investors. So if you are two food companies, so we say Loblaws and Walmart, or Loblaws and Metro. So if they use the same reporting standards, it's easier for an investor in the retail side to properly analyse the performance of the companies if they're using the same standards to report. So the framework is the foundation for building a set of accounting concepts and objectives, and it's a reference of basic accounting theory for solving new and emerging practical problems of reporting. So so as tech companies came on stream, it's how would you conceptually set standards for tech companies and the measurement of their value on their balance sheet being intangible as opposed to physical assets. So the conceptual framework for financial reporting, you can just see, so the foundation principles are the how, so how you implement it, and you go right up to the objectives of financial reporting, the why, so it's the goals and the purpose of it. And in between, what joins the two up are the qualitative characteristics and the elements of the financial statements. So the overall objective of financial information is to provide information that is useful to its users. Excuse me. So investors, creditors, etc. And a word that we've used a bit is decision relevant, so resource allocation. So we mentioned the word decision a lot in Chapter 1, and it's basically that you can make decisions based on this information. And you can just see here again, resource allocation decisions are assumed to include assessment of management stewardship. So we mentioned that in chapter 1 as well, as this, how are the management managing the business? Are they getting the sufficient return on the capital employed in the business? So we were talking about the scarcity of resources being capital. So is there a sufficient return on that investment by the management who are managing the business? And the conceptual building blocks of the second level include what we said down here was the qualitative characteristics and elements of financial statements. So just looking at the next slide then, the fundamental qualitative characteristics, so it's the relevance and the representational faithfulness. So the relevance, so that make a difference in the decision. So it's relevant information about the business, and it's predictive and feedback confirmatory value, so that the information that you share, that it'll impact the users and the word we're using, the decisions of the users of whether to invest or not invest, or to sell their current investments. So we want it to be complete, so neutral, so free of bias and free from material error. So enhancing the qualitative characteristics are comparability, verifiability, timeliness, and understandability. So the comparability piece we've already touched on is that companies in one sector that we can properly compare two companies in the same sector. So if it's in the oil or gas side, that the two oil companies report to the same standards, so we can properly benchmark them. So verifiability, that the results are easy for a third party so an auditor can verify them readily, and they're easy to follow, so that they're timely, so that they're produced annually and on time, that companies now will in the next couple of months release their 2017 financial results, so you're not waiting till 2019 or 2020 to see how a company performed in 2017, because the longer you leave it, the less useful the information is, due to timeliness and understandability, so that we'll be able to understand it and have enough information to make an informed decision on the business. So trade-offs and cost benefits. So the trade-offs piece is not always possible that you can get all the information, but that the information that you do get will enhance the qualitative characteristics and the information that you receive in the business, so that basically you're not trading off critical information for less critical information. And then the cost benefit. So again, so this is for you internally in the business. So any information that you produce, so if it's just a nice to have snazzy brochure, but there's no benefit of it, it's a cost to your business. Whereas if it's a prospectus that we mentioned in chapter 1, that external parties might invest in your company because of the prospectus, then there's a value to producing that other financial information. Whereas if you remember from chapter 1, the required information like the income statement of financial position, cash flow, changes in equity, disclosure notes, they're required. So even if they don't have a cost benefit, if the cost outweighs the benefit, they're still required. Whereas the other financial information that you're producing, it might be just nice to have but not beneficial. So basic elements of financial statements. So this should be familiar. So on your balance sheet, you're going to have assets, liabilities, and equity. On your income statement, you're going to have revenues, expenses, gains, and losses. So assets have three key characteristics. They involve some economic benefit to the entity. Entity has a control over that benefit, and benefits result from a past transaction or event. So like a fixed asset, like a building. So if the building that you're used to manufacture a product, that asset has an economic benefit to you. You have control over the benefit of that asset because you own it and you can use it, and the benefit from the past transaction or event. So goods that were produced at that site before have been sold, and you have realized some revenue because of that. So liabilities also have three key characteristics. They represent a present duty or responsibility. Entities obligated and has little or no discretion to avoid duty of responsibility. An obligation results from a past transaction or event. So with this one, you could have your key suppliers who you're buying a raw material from. So in this situation, it's like you owe them for the purchase of the raw material, and like you're contractually obligated to pay, and results of past transaction or event. So when you bought that inventory, you made a finished good and you sold that good with it. So equity then is your net assets and represents all residual interest in assets after liabilities are deducted. So it can be stuff like your retained earnings will go to your equity and your shares in the business, etc. So revenues increase economic resources resulting from ordinary activities, whereas expenses decrease economic resources. So economic resources such as cash. So the more revenue you earn, the more cash you have in the business, but the more you spend, the more cash that leaves the business. So gains increase in equity, so the net assets that we mentioned on the previous page, and losses and other comprehensive income. So losses decrease in equity, and then you can have other comprehensive income. So you can have revenues, expenses, gains and losses that are recognised in comprehensive income but are not included in net income. So unrealised gains and losses on securities. So they're not core to the business. So with the manufacturing company, it doesn't relate to the ordinary operating activities that we mentioned above, with regards to revenues and expenses. So or ordinary revenue generating activities. So with the expenses, it could be the purchase of the raw material that produces the good. The good then is sold, and then you get your revenue, and that's the cash cycle going on up here. So the foundational principles and the foundational concepts and constraints help explain which, when and how financial elements and events should be recognised or de-recognised, measured and presented and disclosed. And they act as guidelines for developing rational responses to controversial reporting issues. So if we look at the next slide, so then for the recognition or de-recognition, so the economic entity assumption that we mentioned above, and that you have control over it, and revenue recognition and realization principle, and the matching principle, which we'll go through all these in a moment. But we also look at it across measurement, and we look at it across presentation and disclosure. So just looking under so recognition and de-recognition. So the recognition is the process of including an item on an entity's balance sheet or income statement. And the elements of the financial statements that have historically been recognised, when they meet the definition of an element, so that it's an asset, they are probable and they are reliably measurable. So a simple example that will cover all this is accounts receivable. So accounts receivable would be product that you have sold on credit. So it's credit sales. So you didn't get cash up front. So you might give your customer 30 days to purchase, to pay for that asset that you sold, or for the product you sold. So now you have an asset called an accounts receivable. So it already meets that definition as an asset because it's money owed to you. So it's probable. So it's a customer you might have dealt with before and they always pay. So it's probable. It's reliably measured. So if I sell 10 pens for $1 each to you, you owe me $10 for the 10 pence. So it's reliably measured. So then a de-recognition process is the process of removing something from the balance sheet or income statement. So it could be something that doesn't fit this criteria anymore. Or it could also be an asset that you've used. So it could be an asset that you're selling. So like old machinery, etc. So economic entity assumption and the entity concept. So we mentioned initially in chapter 1, and now we're looking at it in more detail here. So the economic activity can be identified with a particular unit of accountability. The business activity is separate and distinct from its owners and any other business unit. and individual departments or divisions of an entity or an entire industry may be considered separate entities, does not necessarily refer to a legal entity. So legal entity concept is used for tax and legal purposes. So what that means there is you could have a big company like GE, so General Electric, and GE have an aviation business in Ireland. So if you think of it against the points we've mentioned here, so you could have a legal entity called GE Ireland from a tax and legal purpose, but within GE Ireland you may have basically a department or a division called aviation leasing. So it's separate and distinct from other areas of General Electric. So if we look on the next slide, you can see then you have the parent or the legal entity, you have the subsidiary or the legal entity, and then you have the economic entity. So it's the economic. So what are you making your money from? So in that example, you're making money from leasing aircraft to airlines around the world. So from a control point of view then, it's an important factor in determining entities to be consolidated and included in that economic entity. So some concepts of control include, so remember we talked about IFRS and ASPE. So the easy way to remember between the two is if you're a publicly traded company, you have to report under IFRS. If you're a private enterprise, you typically report under Canadian GAAP, but you can report under IFRS if you choose to do so, but you're not obliged to. So having power over the investee, exposure or rights to variable returns for involvement in the investee, and ability to use power over investee to affect amounts of investors' returns. So an easy way of summarising this is with the GE example. So GE in the US would have full control over GE Ireland, with GE Ireland being a subsidiary of GE. So under ASPE, continuing power to determine strategic decisions without cooperation of others. So if you're a private enterprise, that you, the owners of that enterprise, can make all the decisions for the business on your own. That you don't require. You can do it autonomously without seeking permission from anybody else. So you're not a subsidiary of a larger business. So the revenue recognition principles, we mentioned it a couple of slides back, but revenue is recognised when risks and rewards have passed or the earnings process is substantially complete. And we'll look at the contract-based approach in Chapter 6, so later on in the semester. The revenue is measurable and the revenue is collectible, so realised or realisable. And we'll look at all that in more detail in Chapter 6. An example we use in Chapter 6 is a bike company in London is selling its bikes through a bike shop in Vancouver. So it's when you recognise the revenue is when a third party, so a customer, walks in off the street in Vancouver and buys the bike from the bike shop in Vancouver, and they notify you in London that somebody has bought your bike. Then and only then you'll recognise it as a revenue on your balance sheet or on your income statement. Excuse me. So it's the risks and rewards have passed, or the earnings process is substantially complete. So the risks and rewards have passed from you to the patron in Vancouver who has bought the bike and left the bike store with it. The revenue is measurable, so say we're charging $1,000 for our bike, and the revenue is collectible. So the bike store in Vancouver has collected that revenue on your behalf. So revenues are realisable on products, so goods or services, merchandise or assets are exchanged for cash or claims to cash. And again we'll look at that in more detail in Chapter 6. So matching principles. So expenses are matched with revenues that they produce. So the simple example we were using was the raw materials. So if I buy raw materials to produce a product, when I sell that product and I receive revenue from that product, I'm matching that expense to that revenue. So say if I bought a part for that bike, like the chain for that bike, if I bought that from a supplier of bike chains, then that expense will be attached to the revenue that was earned from the sale of that bike in Vancouver. So it's there's a cause and an effect relationship between money spent to earn revenue and the revenues themselves. So you spend money buying the chain as you build the bike, and then you earn the revenue when you sell the bike. So if expense benefits the future periods and meets the definition of asset, it is recorded as an asset. So that could be a prepayment. So if you're prepaying for something, and then this asset's cost is then systematically and rationally matched to future revenues. So if you've prepaid for some stock or an inventory, would be an example of that. So now we're going to look at measurement. So all elements must be measurable to be recognized. So it can't be a case of that you can measure most parts of the of a product that you're selling, but not one part you can't put a value on it. Then you don't have a reliable measurement. So because of accrual accounting, which we'll see in chapter 3, many elements of financial statements require the use of estimates, and this brings with it uncertainty. So you want a measurement to be reliable. So therefore we must determine the level of uncertainty that is acceptable for recognition, the appropriate measurement tool, so how did we estimate it, and disclose sufficient information to describe the uncertainty. So, and then the periodicity of assumption. So economic activity of an entity can be divided into artificial time periods for reporting periods. So a month, a quarter, a year, etc. So for shorter time periods, more difficult to determine proper net income. It's more likely errors become due to more estimates. Now, however, on this one, using the Loblaws example or the Metro, Loblaws and Metro will look at how that business is performing on a weekly basis, and typically in the retail sector you will have 13 periods as opposed to 12 months. So if you think of it with 52 weeks in a year, so if you divide it then by 4, you'll get 13. So you'll have 13 periods of 4 weeks each. So with technology, investors want more online real-time financial information to ensure relevance. So you want the information now. You don't want to know. So in the Loblaws example, you'll want to know on Monday morning how the business has done this week, not in 3 or 4 weeks' time. So monetary unit assumption. So money is the common unit of measure. And I think this should be something that everybody should easily recognise. So in Canada and the US, the dollar is it's what's used. So you have the Canadian dollar and the US dollar. So the monetary unit is relevant only as long as it's assumed that quantitative data are useful in communicating economic information. So basically, it's universally available and useful as well, and it's a simple and understandable unit of measurement. So the going concern assumption, so the key thing here is that management must look out at least 12 months from balance sheet date, that the business will still be trading or operating in 12 months' time. So if you think it's going to liquidate within 12 months, then you will use liquidation accounting at its net realisable value. So full disclosure is required of any material uncertainties. So when you're producing your financial information, you have to fully disclose anything that could cause the business to cease being a going concern. So a good example there would be Sears. So if Sears knew that they were folding at the end of last year, that should have been notified at the end of 2016 or early 2017. So now we're just looking at the historical cost principle, and with 3 basic assumptions. So it represents a value at a point in time. It represents a reciprocal exchange, so a two-way exchange. And exchanges includes an outside of arm's length party. So this is that if we go back to the manufacturing example, that if we bought a machine to produce the goods, that basically we bought it for a sum of money, so $1 million, and it was a two-way exchange. So we bought it off somebody else, and it was at an arm's length. So we didn't buy it from somebody else in our business, and that it would normally be worth 4 million, but we bought it from 1 million. So it was an arm's length party, so somebody independent of us. So initial recognition. So for non-financial assets, record all costs incurred to get the asset. So you can just see it includes transportation and installation costs. So if I buy a piece of machinery in Detroit and it costs me 50,000 to transport it and basically install it. If the cost of transporting it from Detroit and getting it installed with millwrights and technicians and getting it fully operational cost me 50,000, I need to include that on top of my 1 million. So my full cost was 1,050,000. And this is something that we'll see more in chapters 10, 11 and 12 towards the end of the semester. So historical cost principle. So its measurement is especially challenging for non-monetary transactions. So asset exchanges or the purchase of assets without using money. So we'll look at that in chapter 10. Non-monetary or non-reciprocal transactions. So if it was donated to you, again we'll look at that in chapter 10. Related party transactions, so not acting at arm's length. So using an exchange value or a cost. So is that if it's a parent company and a subsidiary, how that asset is changing hands within the group of companies. So it also applies to financial instruments, so like bonds, notes, accounts payable, and accounts receivable, not just to physical assets. So the fair value principle, and again this will be very important towards the end of this semester in chapters 10, 11 and 12. So the fair value has been defined under IFRS. So IFRS will typically look at fair values, and this will become more apparent later on in the semester. So the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at a measurable date. So subsequent to initial recognition, historical cost and fair value often differ, and we look at that in the next slide. So it's basically saying you could buy a condo development in downtown Toronto, say for 50 million 2 years ago, and that's your historical cost, and that might be now worth 75 million, which is your fair value. And the fair value is considered more relevant for certain assets liabilities, so like financial instruments, so bonds and assets. So if the value is increased or decreased on the Toronto Stock Exchange, the fair value will be higher or lower than what you purchase it for. So IFRS allows the use of fair value measurement in more situations than ASPE. So under private enterprise GAAP, you'll typically use a cost model, or so your historical cost, as opposed to a fair value. So the fair value principle continued, and under IFRS, so the entry price, the purchase price, so what we bought the asset for. So then we have a value in use, or so say depreciation. So we look at this in chapter 10 and 11 and 12, and then the exit price, so the selling price, so the market price. So it's the fair value based on this. So if I bought an asset, a machine, today for 20 million, and I've depreciated it down by 10 million, so I've a carrying amount of 10 million because I've depreciated 10 million of the 20 million. But on the open market, somebody else might say to buy that machine on the open market is 8 million, then the fair value is 8 million, the historical cost is 20 million, and the carrying amount is 10 million. So full disclosure principle, so it's the practice of providing information that is important enough to influence an informed user's judgment and decisions. So that we should fully disclose any notes to the financial statements. So just like what we're saying is like a going concern. So if there's something that threatens the probability of the company existing in a year's time, i.e. that it'll be a going concern, that needs to be a note should be provided to the financial statements and fully disclosed. So, and it'll be within the main body of the financial statements and notes to the financial statements. So if you remember in chapter 1, we were looking at what were the main financial information that's recorded. So it's It's your statement of financial position, or balance sheet as I like to call it. It's your income statement, your cash flow statement, your changes in equity, and your disclosure notes. So your disclosure notes are disclosing across the other across your financial statements, being the income statement, statement of financial position, i.e. Balance sheet and cash flow statement. So, and then supplementary information might include management discussion and analysis. So you might volunteer that information. So with the full disclosure principle, disclosed information should provide sufficient detail of the occurrence, be sufficiently condensed to remain understandable and appropriate in terms of cost of preparing and using it. So full disclosure is not a substitute for proper accounting practice, and notes of financial statements are essential for the understanding of enterprise's performance and position. So that's just like what I was saying, that you still need to produce the information against accounting standards, but the disclosure notes should be just additional information so you can properly interpret and use the financial statement information. So management's explanation of financial, so we're talking about this management discussion and analysis. So there's 5 key elements, and basically this is like what you'd see in an annual report. So you'll have stuff like the president's letter, and then you'll have a section for a company's vision, core business, and the strategy of the business. The key performance indicators or drivers. So even you'll have your historical financial results at a high level up here. So then you look at your capital and other resources, so your funding and how you're sourcing your funding, whether it's through loans or through equity. Equity being shares, and then historical and prospective results, and then the risks. So if you remember, we were looking at stuff like what's at stake for all the shareholders in chapter 1. So what risks? So stuff like reputational risk, financial risk, operational risks, etc. So we were looking at the expanded. So we'll just look at the expanded conceptual framework. So we looked at it earlier, and if you remember, we had the foundation principles, the qualitative characteristics, and the objectives. So we were looking at stuff like the economic entity and the control and revenue recognition, and the matching and the periodicity, monetary unit, going concern, etc. And we're looking at the historic costs and the fair value. And then as we go through the pyramid, so this is all the how, and the why then is the goals and purposes. So it's useful in investment and credit decisions. So we mentioned that in chapter 1, and useful in making resource allocation decisions, so even just decision making. So the middle section is basically helps us make our decisions. So financial reporting issues. So remember, we're saying that IFRS and ASPE GAAP are principles based. So when we select and interpret accounting principles and rules, rely on application of professional judgment. So legally structuring transactions so that they meet the company's financial reporting objectives is known as financial engineering. So complying with the generally accepted accounting principles. And when pressures for reducing specific financial reporting objectives are high, risk of fraudulent financial reporting increases. So it's like the Enrons and the WorldCom. So that's why we looked at stuff like the Sarbanes and Oxley Act in the US, and basically the need for independent audit committees, etc., because of the risks of fraudulent activity. So choice in accounting. So remember again, decision making is a key word. So accounting for bona fide business transactions in a transparent way with no bias. And you're using professional judgment, aggressively interpreting GAAP so that the impact of critical financial statements and numbers ratios is minimal, because we want GAAP to be relevant, and we want it structured so that bona fide business transactions minimize the impact on debt covenants. So from a banking point of view, if you get a loan from a bank, that the covenants are met. So basically that the terms and conditions of the loans are upheld, so that you're not pretending that you're meeting your financial ratios. and that entering into specific business transactions for the sole person making financial statements look a certain way. So like fraud. So that you don't want to end up in that situation. So that's chapter 2. And the things we were looking at across chapter 2 was conceptual framework, and how it's designed and built to support financial reporting, and how it was developed. And we were looking at information asymmetry in chapter 1, so it was adverse selection and moral hazard, so the qualitative characteristics that we use to avoid this. And then we were looking at the elements of financial statements, like our assets, liabilities, incomes, expenses, gains, losses, etc. So how we recognise and de-recognise assets and liabilities, how we measure them, how we present them and disclose notes if required, so like for things like going concern. And then our principles-based approach, financial information and financial fraudulent financial reporting. So looking ahead, it's an ever-evolving environment where items like IFRS and ASPE GAAP are constantly updated to stay up to date with how modern businesses are operating, so that it remains relevant, basically, that the standards we use are still relevant now, and that we're not using redundant standards.